Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter. Joining me today is David Barse, the founder and CEO of XOUT Capital, who is the index provider behind the Granite Shares ETF XOUT. This is David's second time on the show. I wanted to have him on because his firm produced a white paper on the cost of underestimating technological disruption. David, thanks so much for coming on to talk about your paper.
Jay, it's a real pleasure to be here, and thanks for inviting me back.
You know, it's great. I've read that paper 3 or 4 times now in preparation for this, and I still botched the title on the intro. All right. So first off, if you're listening to this, please go download a copy of the white paper by visiting XOUTcapital.com. That's XOUTcapital.com. We're going to talk about it at a high level. You'll really enjoy the granular details in this white paper. So let's start with this question, David. Why did you write the paper?
Well, look, I just think the market has begun its bifurcation, and you hear a lot of people talking about it and using historical or traditional financial metrics to try and explain it, but at the same time question it because they don't understand valuation. The reality is that technological disruption is disrupting even traditional valuation metrics. And so I wanted to try and dumb it down, quite frankly, and explain why people might be underestimating this disruption that's going on and help them get a handle on it and not be scared, maybe is the right way to think about it, from what all the pundits out there are talking about when they say stocks are overvalued, and then they are left behind, right? They have FOMO. They just missed it, and then they're scratching their heads in wonderment as to why. And this helps them at least get more comfortable with some of the dynamics going on.
So, David, that's actually one of the reasons this stood out to me. You know, I started my career in the 90s, a value guy. I went to graduate school after the turn of the century and learned about the importance of balance sheets and income statements. And you looked at the PE levels, as we've seen over the last 12 years. And there was no rational reason for why some companies were getting the valuations that they were getting. And it was hard to explain. And that led me down the path of taking a deeper dive into technical analysis and quant investing. And what I thought your paper really does a good job of is helping people who haven't quite made that bridge yet understand that there are things that have been happening for a long time that you are able to explain how they're going to be able to help investors if you can identify them now going forward. So I want to start with an awesome graph that really hit home to this point. And so for podcast listeners, make sure you download the report at xoutcapital.com. But on the screen, I have the history of technological disruption. Walk us through what you're identifying here in this chart.
Yeah, this is really just a simple way for people to have, quite frankly, an information graphic for events in history that have become disruption events. And we're taking a select few here. There are obviously many, many others. But if you think back to periods of time in which there were either industrial developments and or technological developments that kind of transformed the way we functioned. So you and I were talking a little bit off camera about what happened in the 70s and 80s with the downloading of music, which we really didn't download. We were listening to Walkmans, as they were called, or MP3 players, as they ultimately became. And now, you know, what's happened to digital music has completely transformed itself as to the way in which we get that music, and it transformed the industry, right? You don't buy Walkmans anymore, right? You get your music off your phone, and it's more about the quality of the headphones that you listen to it with. But what I think is the most relevant for folks who are listening today is what just happened to us, right? We had an unforeseen event, a so-called disruption event in the coronavirus, and it transformed the way we're living our lives. No one anticipated this would happen, except for a lot of the companies that were staying ahead on technological change and recognizing that there was going to be a need for us to be more virtual, to be more digital in the way in which we do almost everything. And so what's happened, you've seen massive change in the market dynamics. And that is what's giving us an opportunity to excel in what we do at XOUT, because that technological change is so apparent, except for the people who think about it, right? It's a forward-facing risk. It's not a historical risk. And so we try to decipher or exclude from a large US equity market cap portfolio those companies we think are going to be disrupted. And that's a real flipping of this. So this chart just illustrates these events in history that have changed the way we function. And I can say for certain there will be more disruption events in the future. I just don't know what they are, but they're going to change our behavior. And the companies that are preparing for it and thinking about it all the time are going to be the winners. Those are really hard to select. For me, it's much easier just to exclude the losers.
So kind of walking podcast listeners through this chart, it talks to, MTV and the Walkmans being around at the, late 70s into the early 80s and how that changed things. And then into the 90s, mobile phones and the change that they brought. And I can remember thinking myself in the 90s how mobile phones weren't going to be as big a deal as some of the folks on Wall Street said they were going to be. Then you move into e-commerce and Amazon, the most overvalued company by traditional metrics for a really, really long time. Then the advent of GPS at the beginning of the century, or the commercial application of GPS at the beginning of the century, digital musics in the 2010s, along with social media. I remember being at Morgan Stanley when they rolled out some of the Facebook IPO, and I thought, who in the world is buying this type of toy? It just didn't make any sense. Clearly, I was wrong. It was disruptive. And then you get to today. In the 2020s, we have blockchain technology, 3D printers, and now 5G. David, what are the biggest trends you see going forward for the rest of this decade?
It's speed, right? Everyone is trying to do what they do currently faster and with more, to use the term, broadband, right? More ability to capture more information in a faster way and be able to transfer that information and use it effectively in everything we do. And that's sort of the foundation behind blockchain and artificial intelligence, learning how to do what we do better and faster. And so hopefully things that are impacting us right now, like supply chain disruptions, are going to get solved for through these new technologies. And ultimately, that's the thing that I would expect most people to be focusing on, especially over the next couple of years, because the current impact to the marketplace in terms of supply chain is what I think a lot of investors are focused on and worried about a little bit. And we'll see how it translates. Although last quarter's earnings, which are all coming out right now, are showing a little bit of signs of how folks are going to deal with that. But I'm certain they'll get through this period in a reasonable period of time. But I look at blockchain and AI as really the answer to companies solving a lot of their problems that might have been caused by supply chain.
Yeah, it's an absolutely fantastic and phenomenal space to watch unfold. I'd like to say I can understand it all. I'm trying. It's very, very complex. And that's where there's value in understanding complexity and how it can have an impact on an industry or society. So when you think about the industries that are impacted, we've talked about some of the positive industries. Who's going to get left behind in these changes?
Yeah, so it's not surprising to folks that things like energy and hard retail, not e-commerce retail, but big box retail, utilities, in some cases, media and telecom. They're trying to take advantage of 5G, but it's a massive investment that has to be made, and their businesses are so traditionally based on making dividend payments and borrowing capital to be able to do that. So it's going to be a race to see if they can get ahead of that sort of debt cycle. And again, we're about long-term secular decline. Some of these large companies that have used the debt markets, albeit they were inexpensive, to finance the way in which investors invest in those companies, for us, those are real challenges, and I'd be cautious. And so for us, again, it's much easier to figure out what not to own than it is to what to own. And so just by excluding these companies, we've created a massive outperformance, if you will, over a broad index like the S&P 500 just by not owning those companies. So those are the obvious sectors, but my fundamental argument to everyone is that technological disruption is impacting all companies, not just those industries or sectors that I just mentioned, but even technology companies. And I'll pick on, the largest company that we've X'd out, which is Visa, a global payments company that's characterized as a technology business, and yet we've excluded it. Why? Because its revenue growth has slowed down. It's being disrupted itself by many of these upstart entrepreneurial global payments companies that are picking apart that sector in multiple ways. And so it's very interesting to watch how all these companies are emerging right now. And what it's doing is disrupting the big gorilla, which was Visa, for so many years.
Interesting. I wouldn't have thought of Visa as somebody that is primed right now for disruption, but you could see what they're doing with the blockchain and payments today. It will have an impact on them. You guys are thinking obviously ahead of the curve on that. I want to show a graph, and for podcast listeners, this is from the report you can download at xoutcapital.com, and it's looking at the historical results of the S&P 500, specifically the technology sector over the long term. We're going to say long term since the mid 90s. Davis, walk us through the three phases that you're detailing here in this graphic.
Yeah, and I want to give credit to CFRA, which is the one who actually produced this chart. They're a research firm that covers the ETF space. But in phase one, you really have a consolidation of indices, and you saw the tech boom of 1999 and 2000. You had many upstarts, people believing that those companies were going to go to the moon. Many of them were either poorly financed or poorly constructed as business ventures. And so you had the bust. Clearly, our environment was not ready for some of those companies at the time. They didn't have the capital to invest in them. And so you had a real consolidation, many great ideas that came out of that period, but a lot of them didn't survive. And so they ended up getting consolidated. And then you moved into sort of phase two, which took you post financial crisis, because the financial crisis obviously had impact on all industries, including technology businesses. But in the 2008 post financial crisis period, really until 2016, 17, you had what I called, or CFRA called, but I love this chart, the mobility age, where people were starting to focus on something called the cloud. It was this amorphous thing. Amazon talked about it each and every quarter, and analysts didn't care. They didn't really think that their cloud business was material enough, and they just kept tracking them or evaluating them based upon how many books they sold. I mean, they just missed it, which is why the sell side isn't really something that people should rely on for their information. They should read actual 10Ks and Qs, and companies wrote about this so that if you could understand it, back to your point, Jay, about complexity, it's sometimes worth spending a little bit of time figuring these things out. But as we got through the mobility age and the cloud started to take over, you just saw things like artificial intelligence get accelerated because of what happened over the last couple of years, and especially what COVID did to really accelerate that, right? It's not just about growth and the change in growth. It's about the acceleration of that rate of growth. And that's what we've seen in this third phase, and something we project will just continue to exponentially grow. So again, what we're trying to do is guard against those companies that are going to be left behind, and not so much focused on trying to figure out who those select winners are going to be that will end up dominating. We will let the winners take care of themselves and just exclude, as I said, those companies being disrupted.
David, before we wrap up, let's go a little deeper on that. Let's walk through the XOUT process from the index level of how you go from point A to portfolio construction.
Yeah, so it's recognizing three important insights, right? Insight number one is flows will continue to go into passive index strategies. in the asset management world. So more money will keep going into passive strategies. That's an insight. Insight two, all indices are flawed in and of themselves because they buy everything in an index. And insight number three is technological disruption, which we wrote about in this white paper, is a forward-facing risk that every investor needs to be cautious about. So how do we do this? We take, in our case, the largest for the first one, the one we've licensed to the Granite Shares XOUT ETF. We take the largest 500 US market cap companies, not the S&P 500. There is a difference between what I just said, the largest 500 and the S&P 500, because about 90 different names, believe it or not. We take those 500 names and we give them a score based upon 7 fundamental metrics. We measure revenue growth. We measure hiring or labor growth. We measure whether they're buying back their stock and they're using free cash flow to do that. We measure how a management team is doing against the other management teams in that mix. We measure what the analyst community sentiment is, and we measure profitability. So we take those 7 factors and we give them each a score. And then we take the bottom 250 scores and simply exclude them. And we rebalance that 4 times a year, each and every quarter, after we've gathered sufficient new financial results that we can put into our model, if you will. And there's no human judgment overriding here. It's simply what the score says governs. And sometimes that's a difficult thing to accept. But in my long history in the asset management business, personal bias is one of the most dominant factors that individual portfolio managers have. And it's constantly wrong. Personal biases should not be a part of one's portfolio. If you're hiring a portfolio manager to manage your money for you, their personal bias is going to weigh in on how they make decisions. And that human judgment is where they most fail. That's why so few people are able to consistently outperform the market. So here we're giving you, if you will, a smarter way to own US large cap securities with a requisite diversification of 250 names that just happen to be the names you want to own because we've gotten rid of the ones you don't want to own.
What type of turnover is the index experiencing on a quarterly and annual basis? Ballpark.
Annually, around 60% turnover. So not quite full turnover, but there are, at least 30, 40, sometimes 60 names each quarter that gets turned over. But we're not yet more than that so far. And it's only been 2 years. So that's all the history I have on that. But it's pretty much what we think will likely be the case.
And then for the portfolio managers and financial advisors that run their own models, where's this fit in an allocation, in your opinion?
This is, the good and the bad of this is right smack up the middle of the fairway for a core portfolio of U.S. large cap stocks. And one might say, well, I'm just going to buy either the Vanguard S&P 500 or the SPY. But this is just a much smarter way to do it because, again, with 250 underlying securities, you're getting fairly diversified portfolio, and we're outperforming those underlying large cap indices by, since our inception, over 15%. So if we can do something like that, it's worth taking a look at and thinking about, even though we have a 60 basis point management fee, the XOUT ETF has a 60 basis management fee. And the number I've quoted, the 15% number, is net of that fee.
Yeah, in prepping for this interview, it really did occur to me, this is a core holding if you want to add it to a portfolio. This is not a satellite to see how it does, because you are diversified with 250 names. You're actively managed in the sense that you are eliminating or Xing out what you think the losers are going to be, but you're trying to capture beta of the large cap space. It is what I just said correct?
It is. And in fact, our beta is almost 1, which makes us, for lack of a better way of describing it, the same risk you take if you own a SPY, for instance.
Mm-hmm. Awesome. I love the story. I appreciate you coming on to share the research. Listeners, viewers, please sure to download a copy of that report at XOUTcapital.com. That is XOUTcapital.com. David, thanks for coming on.
Jay, it's a pleasure again. Thanks for having me.